A very warm welcome to everyone joining us today, and thank you so much for joining us. As David mentioned, we're going to talk a bit more about what we're seeing in the market about cloud infrastructure and security, pricing, and deal trends. So, with that, let me deep dive into the agenda for today. So, we'll of course start a bit with about what's happening in the market, what are enterprises broadly thinking about as they head into 2025 with possibly one of the biggest technology revolutions taking place in the industry, which may reshape our collective futures in the next decade or so. So we'll talk a bit about that. We'll also talk a bit about, in the second section, we'll talk a bit about what commercial trends are we seeing in cloud infrastructure and cybersecurity deals. We'll of course see how has pricing trended and moved in key markets over the last 3 years or so. We'll also give our forecast for 2025. We'll see how pricing models have evolved over the last few years. How has the market evolved beyond just fixed fee and time and material based models? We'll also talk a bit about how mid-tier providers seem to be gaining ground in the market. And then finally, we'll wrap up with a view of, okay, what are some of the more emerging themes that we're seeing in contemporary CIS deals and how deals are expected to evolve in the coming future. So, and then we'll also leave some time aside at the end for Q&A. So if you have any questions, please just put it in the chat box in the Q&A section. We'll try and take those towards the end. If time doesn't permit, we'll definitely get back to you with the responses offline. So with that, let us get started with this. And as I said, please keep the questions coming. So we kind of do a sort of a study with our key enterprises globally. Over 300 400 enterprise organizations participate in this, and we've been doing this for the last 4 or 5 years. We covered this in a detailed webinar a few months ago, but just to have a few glimpse or a few sort of a sneak peek into that study. I think one of the key outcomes of that study was that cost and margin pressures continues to remain amongst the sort of the top business challenges that enterprises are expected to solve for in 2025. Not very surprising, it was the number one challenge that they were expecting to solve for in 2024 as well, followed closely by adapting to evolving customer needs, slowdown in demand. So, having said that, I think uh, so what is that enterprises will do to drive that cost and margin improvement, right? So to be able to drive that profitable growth, they will they will use multiple levers, is what we anticipate. For example, improving productivity, and it's probably one of the most talked about conversations these days with the rise of AI. Improving productivity, optimizing people costs, optimizing shoring and location mix. Those are going to be the key levers. And right now enterprises are, it's not just about containing costs. They're being sort of given this dual problem of, okay, you need to optimize your cost but at the same time continue to demonstrate the top line growth, right? So that's very unique, and that's where we believe that enterprises will sort of accelerate innovation across products and services, improve customer experience, and obviously try to enhance their overall brand reputation. So kind of we're seeing this duality exist in the market where as I said, enterprises are being asked to cut costs, but continue to grow at the same time, which is going to be a bit challenging. Um, with that said, let's continue and talk a bit more about what sort of came out of this survey, right? I mean, and not very difficult to judge. We are expecting some growth to come back in the industry. The last couple of years, we did see the overall industry to sort of have significantly much lower growth compared to what we saw in 2021 and 2022. So these were the years immediately post-COVID. So we kind of saw a rebound, industry growing at close to double digits both the years, but then 23 and 24 were relatively harder, but we're starting to see some growth coming back. Early signs of green shoots. Most service providers have reported fairly positive numbers. Even the providers who were struggling a bit in the last few quarters have started to grow, show some optimism, and started to grow. So that really bodes well for the industry. As a whole, we are expecting the industry to grow by at least 4 to 5% this year, and this includes both the outsourcing market as well as the GBS market, which is close to a thousand billion. Right. So with that, I think let me hand it over to my colleague Rohan to talk a bit about Gen AI. Right. I mean, AI is going to be one of the most disruptive technologies in in our era. So, what did enterprises have to say when we asked them about their adoption of AI in the study?
Yep. Thanks, Ricky. Absolutely, Ricky. You are spot on there, and no surprises. When we did this survey with a lot of enterprises, what they are talking about is Gen AI is potentially going to be the top investment area for 2025, and we've seen some progress over the last 6 months or so. We've seen an increased number of use cases in Gen AI, and we are expecting more and more enterprises to adopt Gen AI in 2025. Now, if you look at the second service here, it's the cybersecurity services, and that is one area where the demand continues. Most of the enterprises uh, see this as another investment areas, and typically so, with the growing number of cyber attacks, there is increased regulations around data protection. So we continue seeing, cybersecurity enterprises investing in cybersecurity. That is something. If you look at the other things, I think these are your standard players there: cloud solutions, IT, automation, analytics. We'll see some investment in these areas also in 2025 by these enterprises. Now, talking about, we've talked about some key areas where enterprises plan on investing. However, what we also see is a lot of enterprises re-evaluating their current service provider mix. And I was talking to Richa just a while back, and Richa, what do you think is actually driving this behavior?
Rohan, every year, Everest Group runs a survey to gauge how satisfied enterprises are with their service providers. And guess what? For the past 3 years, the average satisfaction score has been stuck below 5 on a scale of 1 to 7, with 7 being highly satisfied and 1 being highly dissatisfied. And while below par performance is one of the leading factors, they have another big complaint, which is a lack of flexibility in terms of both how providers solution as well as how they construct their commercial models. They want enterprises want innovative solutions tailored to their unique needs, but providers often struggle to deliver that due to their own internal constraints and end up providing a cookie cutter solution. In fact, in one of the upcoming slides, we'll dive into a case study that shows how a mid-tier provider managed to win a deal, and it not just by being the cheapest option, but by bringing real value to the table. And if you move to the next page, we'll see that uh, this is not just an isolated case. More and more enterprises are rethinking their service provider relationships. In fact, a staggering 40% of the enterprises we surveyed are planning to shake up their provider mix in 25. That number was only 22% in 24. So, yeah, satisfaction is clearly on the decline. And other 37% of enterprises, while not planning to change their service provider mix, but are also looking to rebalance the work across their existing providers, giving bigger share of the pie to the ones that deliver. So it's a wake up call for incumbent providers to step up their game and get more creative with their solutions. The ones that adapt, innovate, and basically tailor their solutions to the evolving customer needs will win. Okay, let's keep things moving. Up next, we'll be diving into some key commercial trends in CIA services and what the outlook looks like for 2025. Um, but before that, let's open the floor to our audiences and get their inputs. Essentially, how do you see FT rate card changes for standard IT skills? Uh, is it 0 to 2%, 1 to 2%, 2 to 4%, or more than 4%? Um, let us know your votes. We'll keep the poll open for 30 seconds. Ricky, what do you think has been the trend in the last 2, 3 years post COVID?
I think it's been a very mixed bag, to be honest. I think in 2022, we did see like a sharp increase in FTE rates. We saw enterprises come to us talking about how providers had been coming to them for rate increase requests, especially in some of the emerging and next gen areas where we saw rate increases in upwards of 6 to 8% across offshore and onshore, right? Offshore is, I think, is pretty much expected, but 6 to 8% increase in onshore was pretty much unexpected. And that's why a lot of enterprises came to us to understand how should they go about this negotiation. But 2023 was relatively much more flatter and muted, and probably the same for 2024. In fact, it was much more flatter. So if I had to put a number to it, probably 25 will be in that second and the third bullet.
Okay, thanks, Ricky. I think we'll deep dive into this in the upcoming slide as well. But now we can close the poll in 5 seconds. Uh, all right, I think most of our audience have answered, so we can close the poll. Uh, so basically, approximately 41% of our voters have said that they anticipate the increase to be in the 1 to 2% range. Okay, let's see how this compares against our
Sure.
findings. Okay. So basically, if you look at the past 12 months, FT rates for standard IT skills like compute, database, and workplace services have mostly stayed flat or even declined. For specialized skills, also, the change has not been drastic, not more than 1.5% across geographies. For specialized skills in general, we saw a slightly higher increase in LATAM in India compared to North America and UK. But here's where things get interesting. If we zoom out and look at the past 36 months, the trend shifts. 2022, coming out of the pandemic, saw a big surge in FT salaries as the market went through a period of rapid growth. Then came 23 and 24, where demand slowed down and enterprise started feeling the pressure on cost and margins. That led to a much more muted increase in FT rate cards for these 2 years. So overall, to put it in numbers, over the last 3 years, standard skills have seen an average increase of about 2 to 5% in North America and India, and about 4 to 4.5% in UK, and slightly higher in the range of 6 to 8% in LATAM. Specialized skills, on the other hand, have jumped by an average of 9 to 13% across markets, a clear sign that while general IT roles are under pricing pressures, niche expertise is still commanding a premium. Okay, and if we look at this trend, it is not just visible at the individual FT level, it's showing up in overall deal dynamics too. On this slide, if you look at the left-hand chart, you'll notice that traditional infrastructure deals have been shrinking in size, driven by multiple factors. Increased competition from mid-tier players, automation reducing standard effort, and a general push for cost efficiency have all played a role in this decline. On the flip side, deals that focus on specialized skills are going in the opposite direction. Take next gen security services, for example. Our analysis shows that deal sizes for these services have grown by 8 to 15% in TCV, and which is not surprising considering cybersecurity is one of the top spend focus areas for enterprises. In fact, the cybersecurity market has been growing at a CAGR of 16 to 18% since 2021. Clear proof that the demand for digital security is only getting stronger and it's a booming opportunity for service providers. To put it simply, routine IT services have become more cost competitive, while specialized expertise is proving to be the real game changer, commanding higher demand and premium pricing. Okay, now let's look at what our forecast for 2025 is. So on the left side, we have talked about a forecast on the FT rate cards, and the right side about the deal TCV changes. First, let's look at the FT rate cards. So analysis suggests that standard IT skills will largely remain flat, or will have just marginal increase in 2025. For specialized skills, we anticipate a slightly higher increase, but not more than 1.5% across geographies. This is a general outlook. However, in the last couple of months, we've started to observe providers while renewing their contracts, pushing enterprises for higher price increases. So the actual changes could be slightly higher as well. Now, coming to the left on the deal TCV comparison, the current trend is set to continue. Traditional infrastructure deals will keep shrinking while those focused on specialized services will continue to grow in value. So for traditional deals, we anticipate an average decline in TCV by 2 to 2.5%. And for deals around specialized skills like next gen security services, we anticipate an increase of about 1 to 2%. Okay, now that we've covered the trends in FT rate cards and deal TCV, let's switch gears a bit. Rohan, could you talk about the commercial models in CIS services? Is it still predominantly RU-based pricing that we have been seeing since last 3 years?
Well, absolutely, Richa, you're spot on there. That is what we've been seeing. And if you look at the pie charts here in both cloud and cybersecurity, output-based pricing seems to be dominating here. By output-based pricing, we mean resource unit-based pricing. That is a per user or a per VM-based model, which continue increasing and can be seen in almost half of the managed services deal when it comes to cloud services, and nearly three-fourths of the contracts in cybersecurity services. Now, the other thing that we see is, we still see, a quarter of the contracts in cloud services being fixed fee pricing models. And we continue to see, enterprises which have a fairly stable environment, and they don't really want to, track every resource unit every month, and they're happy with the fixed fee model, and it gives them much simplicity around it. The other thing I think what we are seeing is percentage of spend model in cloud services. If you look at that 16% here, that is something that is increasing. Now, what is happening is, given hyperscalers, they're launching new services regularly, and the challenge comes with providers and enterprises is how do you keep on creating these new resource units, and especially in complex services like PaaS services, it becomes a challenge. Now, what is happening is providers and enterprises both have started to adopt this model because it seems a simpler approach to them. What happens in this model is, for example, an enterprise, if it's spending 1 million with a hyperscaler, and, it just, then what happens is the vendor calculates, how much services cost would be there, and, they will charge it like 3 to 4% of the services, for example, and this is how they are going to charge for these services. This becomes much simpler for enterprise and vendors to keep track of. So this is a model that's growing in popularity. Coming to cybersecurity services, same here, we see a lot of resource unit based deals here. Three-fourth of them are resource unit based deals. What we are also seeing is a higher adoption of as a service models, and that is the reason you see a lot of consumption based model, resource unit based model here. We see a as a service model where you have tool license being bundled, hardware, hosting, and labor prices being bundled there. Here also, likewise, we see 14% of the contracts having fixed fee services. Now, the other interesting thing is, and we'll talk about it more in the other slide, is the outcome-based models. We see these pricing models now increasing. However, they are still, in terms of percentage, they're still low 6% of contracts are outcome-based pricing. In cybersecurity, it's just 2%. However, what we do see is this model clearly increasing, and we'll talk about it more in the next page.
Yeah. And I think, Rohan, just to add to this, I think there was a question specifically asking around what does commercial models look like for cloud native services? And I think the answer to that really is like in some contracts we've seen, and when I talk about cloud native services, these could refer to cloud and cloud PaaS services. So we kind of differentiate in the market between cloud IaaS and cloud PaaS. Cloud IaaS is more of the infrastructure, VM, storage, all of that. For that, predominantly, it's still sort of RU based construct per VM, per TB of storage, and all of that. But for some of the more cloud native services, cloud PaaS services, because some of these, and as Rohan mentioned, there is sort of that the list of these services is pretty exhaustive. So it's very difficult to create unit-based pricing for each of those services. And that's where we kind of see this percentage of spend model becoming very common, becoming more dominant, especially as more enterprises adopt some of these cloud native services. That's directly linked to what you're actually spending on cloud. Enterprises find that transparency and that flexibility quite appealing. But again, it comes with a bit of risk for both providers and enterprises. And that's why I think that's where the adoption is not as high as we would have probably anticipated a few years ago. But it's definitely rising. Yeah.
Yeah, absolutely, Ricky. Yeah. Now coming to outcome-based model, now I think in the market, I still see there's a lot of confusion around output-based model and outcome-based model. And largely the difference is, your output-based model and or RU-based model. this is based on what is delivered and consumed. So example, if it is VMs, you're consuming VMs and you're paying for that service, it's based on per VM. Now, when it comes to an outcome-based model, the focus is on what is achieved. So especially, when you talk about something like a digital workplace services, uh, what is being CVC user experience here being measured in digital workplace services in the form of DEX score, which are a combination of your various XLA metrics and the pricing being linked to this scores. Now, as I said earlier, we do see an uptick in outcome-based models. However, when you look at this page and you'll see, 95% of the proposals which talk about outcome-based model pricing, they do not see the light of the day. It's only 5% which actually get contracted. Most of the time, what happens is there's a lack of alignment in measuring and quantifying the metrics that can be linked to outcomes, and this is what becomes an impediment. The thing is, the challenge lies in establishing baseline metrics and also associating a dollar value to them. And this is what happens is this leads to resistance from a lot of vendors, which might be sometimes due to lack of maturity and understanding of how to link IT outcomes with client businesses. So vendors are often unsure, what the impact of this outcome-based fee would be on the client business. And they tend to overcompensate on this and end up actually increasing the overall base TCV. Saying that, the fault, I would say, not only lies, it's not just the vendor who's always at fault. It's often we've seen a lot of resistance from client procurement teams also in actually incentivizing the vendors for this model. And in our opinion, this model, though it's picking up and it is slowly evolving, and we have seen successful instances where both, vendor and enterprise both are at a good level of maturity and have a good understanding of how these outcomes are actually impacting the client businesses. And that is where we have actually seen this model being a success. I think going on, I think we expect this model to grow in coming years, and that's likely to happen. So, I think moving on from outcome-based models, I think we also want to talk about how, service provider pricing strategies, they're differing based on uh, client industries, and that is something that we've been seeing more often now. What we've observed is there is a difference in the way vendors are solutioning and pricing for different industry verticals. So, while in cloud transformation services, we see verticals like healthcare and life sciences commanding a premium. Now, these enterprises, they're willing to pay more and typically at higher end of market pricing. For life science and healthcare, you can see, at an average, you can see a 15 to 20% of premium there. And at the same time, for something like manufacturing, energy and resources, banking, financial services, public sector, uh, we see the contracts are very competitive here, and they lie at the lower end of the spectrum in terms of pricing here. However, at the same time, when we talk about cybersecurity services, there's a slight difference here. Now, cybersecurity services, what we see is clients from life sciences, healthcare, banking and financial services, manufacturing services. Now, they are willing to pay more for these services here, and someone like technology, media, telecom, travel, and hospitality, they are at the lower end of this spectrum. Now, the question is, what is actually driving this behavior? Uh, Now, this is to do, with the size of the deals, BFSI, you typically see the size of the deal is pretty high. At the same time, you also see higher regulatory requirements in financial services organizations, giving very high importance to cybersecurity. So the requirements for delivery are much stringent in some cases, and willingness of clients to pay more for top quality talent. And thus, providers do get an opportunity to charge more here. Thus, from a pricing point, if we have to sum up, is it's very important to tweak your strategy based on the client industry. As different industries tend to have different behaviors. On that note, on that note, we want to help you on your pricing strategy, and we have a complimentary price check offer in the next page. Yes. So, what So for all the leaders here, what we are offering is, the audience can choose from this following complimentary offer. We will offer you price check up to three standard roles from cloud services, cybersecurity, and IT service desk. So you can choose these roles from any three countries from a below set of six countries. That is UK, Germany, India, US, Australia, and Canada. So the link to this is at the landing page in the chat. You can click on it and you can get all the details there. Uh, so that is it. And now, moving on. So I think Richa earlier was talking about, more organization, more enterprises looking to change their provider mix. And that's where we made a comment that mid-tier providers are gaining ground. So Ricky, I think you've done some analysis on mid-tier providers and their behaviors in deals for some time. Why don't you share some insights with us on
Right.
this?
Sure. Thanks, Don. So, what we've observed is that in the last couple of years, we've noted that mid-tier providers have tended to significantly outperform their tier one counterparts, even though the base may be much smaller, and that's the argument. But then mid-tier providers are definitely growing at healthy double-digit growth rate for most of them, compared to their tier one counterparts, which are growing at low single-digit sort of rates. So, and mid-tier providers, in our definition, would include vendors which are sort of in that billion or 2 billion sort of revenue numbers. It could include firms like Persistent Systems, Buildersoft, KPIT, Coforge, Sonata, Globant, and so on. And all of them have grown at healthy double-digit rates over the last couple of years or so. Now, let's take a specific example and then understand what's really happening, right? Let's peel the onion a bit. So, this was a specific financial services organization in North America. This was a large 50 million odd outsourcing opportunity, and a leading India-based tier one provider was actually the incumbent over there. But so the client, of course, I think and this was one of the things that Richa mentioned earlier, that there has been generally a level of dissatisfaction amongst service providers and amongst clients in terms of the satisfaction they're getting from the service providers. And this was just one of those cases where the client wasn't happy in terms of the kind of innovation the vendor brought to the table and so on. So they went to the market, released an RFP, solicited bids from multiple vendors, and the release is bid to of course, a couple of tier one India providers. One of them was the incumbent. They also involved a mid-tier India-based service provider and a leading global US headquartered service provider, sort of a more premium provider. When the bids came in and as the negotiations progressed, the analysis suggested that, of course, the incumbent was the most competitive. Not very surprising there. The second India-based tier one provider was very close. They were at they were sort of 1% higher than the incumbent provider, but the mid-tier India provider was actually 25% higher than the incumbent provider. Again, this is not to say that this is always the case, but in this case, it was. In this particular deal, it was. And surprising bit is that. The client did actually go ahead and choose to work with this provider C, which was a mid-tier India-based service provider, in spite of them being not being the lowest cost bidder in the room. They were 25% higher. So again, just to reiterate, not to say that this is the norm and this is always happening, but just to illustrate the example that yes, there are clients who are willing to pay premium pricing provided they are getting the solution that they desire. And then let's read deep dive a bit more in terms of what really happened in this case, right? So specifically, I think the kind of inputs that we got from each of those for each of those providers suggested that, for example, for the provider rate was that their approach and alignment didn't really reflected that they didn't understand the client need. They were falling short on how they approach our needs, and this was sort of verbatim feedback given by the client. Specifically for another provider, it was said that they're primarily driven towards their view of the operating model as being best in class, and not necessarily oriented towards how the client wanted to function in collaboration with the parent organization. But specifically talking about provider C, which actually won the bid, I think the good part that the client mentioned was that they were not just fixated on having specific SLAs or RUs, or they were more fixated on understanding what the client needed to run the business. They showed a great understanding of their ecosystem, their complexities, how they how the client worked with their other entities and business units, and they did not really focus on being the cheapest option, right? But rather focused on and understood the approach, demonstrated a lot of flexibility in resourcing, produced multiple solution options, and which reflected some sort of creative delivery approaches. So also the advantage of not being a tier one actually did work in their favor in this case. Sorry about that. If we talk a bit more about this, right? What's really happening, right, for mid-tier service providers? How are they continuing to do so well in the marketplace? So there's generally a perception that mid-tier providers are often the lowest price provider, often pretty competitive on pricing, and that may be true, that may not be true. There are certain instances where we've seen that mid-tier providers are fairly competitive, especially when it comes to their local markets. For example, we've seen that a local provider in LATAM may be very, very competitive in the LATAM market, but when they're bidding on a global opportunity, they may not be as competitive. So pricing is, yes, definitely one of the angle, but it's not the only thing. We've often sort of in the past, there was a view that mid-tier providers tended to do well in single tower deals. For example, they were specifically asked to do, let's say, Office 365 support or Active Directory support and not the entire digital workplace tower. But then now we're starting to see increasingly that given the good quality of work they're putting in, the kind of resources they are staffing, clients generally tend to appreciate the value they bring to the table, and that's why we're starting to see that they are increasingly getting more wallet share, and we've seen them to be successful even in sort of more sort of larger 30 to 60 million deals as well. And the biggest advantage which works for in their favor is that they do not sort of always try and push the standard offerings, right? Instead, as I mentioned on the earlier slide as well, they tend to be a bit more flexible in their solutions and commercial approaches. And of course, because their organization structures are a bit less rigid and less hierarchical, they tend to work a bit better with the client organization. So those are some of the key findings that we had specifically for the mid-tier, sort of the mid-tier service provider segment. Um, Moving on, let's talk a bit more about some of the more emerging themes that we are seeing in the market, especially around outcome-based deals, XLAs. We spoke about that as a service deal. So what is it that we're seeing in deals? So Richa, could you talk a bit more about what did we observe in the market, especially when it came to sort of contemporary deals?
Sure, Ricky. The biggest buzzword right now is Gen AI. It's everywhere. More and more providers are embedding Gen AI use cases into their solutions, and especially in areas like service desk, threat management, and digital workplace services. And it's not just for show. These AI-driven solutions are actually driving measurable improvements in pricing and productivity, especially in multi-year deals. Another big shift we are seeing is around vendor consolidation. Large enterprises are looking to consolidate their apps, infrastructure, and BPO operations under a single vendor, aiming for better integration and efficiencies. We are also seeing consolidation opportunities within individual service towers. For example, clients looking to consolidate their digital workplace portfolio to one to two vendors instead of having separate vendors for service desk, field services, print services, mobile device management, and so on. Um, another theme is that given the rise of AI, clients are naturally concerned about security. So we do anticipate that the spending in security will go proportionally to the rise in spend in AI, and thus cloud-centric security offerings like CSPM, CWPP, SASE, etc., will be on the rise as well. And as organizations double down on securing their digital environments. We are also seeing a move towards as a service models with enterprises shifting from capex heavy investment to more flexible opex investment. Recently, when a North America based manufacturing organization had to refresh their end user devices, they chose to go with a device as a service model so that the vendor owned all the devices on their books and managed the entire device life cycle. Um, Another key trend that we've been observing over the last 2 years is the increased adoption of XLAs, and Rohan also talked about it. So basically, XLAs uh, are being adopted now in commercial constructs with financial incentives attached to it, and instead of just it being just measured as another KPI. So yeah, these were some of the top themes in the CIS space. Um, we'll move on, and okay, it's now time for another poll for our audiences. What is the extent of offshoring you're observing in contemporary CIS deals? Is it more than 90%, less than 60%, or somewhere in between? Let us know your views. And while our audiences are voting, Rohan, What do you think the offshoring has increased post-COVID? What do you think has happened to offshoring in the last few years post-COVID?
Yeah, I think post-COVID, we've seen a drastic change when it comes to offshoring, Rich. I think most of these customers now are Gen 3, Gen 4 customers, and they're very open to offshoring. I think earlier it was like a 65, 70 was a norm. Now we are seeing offshoring more than 85% also in a lot of cases.
All right. Thanks, Rohan. And this is exactly what we will sort of double click into the next slide. And essentially, as you mentioned, offshoring should vary basis the customer outsourcing maturity when crafting a solution. And we'll deep dive into it. But before that, let's close the poll in 5 seconds. So, five, four, three, two, one. Okay, and if we look at the results, most respondents have expected the offshore have selected offshoring range in the 75 to 85% bracket. Um, okay, let's see how this stacks up again our findings. If we move to the next page, yeah. Okay. So basically, our analysis suggests that the level of offshoring should really depend on how mature a client is in their outsourcing journey. For first and second generation outsourcers, it typically falls between 70 to 85%, as some of our audiences predicted. But for more experienced clients, those in their third or fourth generation of outsourcing, it's usually above 90%. And it's not just the offshoring levels that vary, other factors shift too. First and second generation outsourcers tend to have more room for productivity improvements. They have larger deal sizes and a heavier governance structure to manage operations. On the other hand, more mature clients have already optimized the basics, focus on alternative cost saving opportunities like leveraging tier 2 and tier 3 delivery locations, streamlining their governance, and optimizing their transition models. Um, Simply put, as clients mature, their priorities evolve, and from standard efficiency gains to more strategic cost optimization approaches. So, Rohan, where does Gen AI fit into this story? Is the adoption of Gen AI consistent across Gen 2 versus Gen 4 customers, or do you see any other trend?
Yeah. So, Richard, talking about generative AI, now generative AI is an opportunity for all, be it Gen 1 or a Gen 4 outsourcer, to jump into the bandwagon. However, the impact of productivity on Gen 1 outsourcer might be significantly different than with a Gen 3 or a Gen 4 outsourcers. So if you observe the graph on the left, what we've seen is, in the last 7 to 8 years, the standard automation process improvements, they have led to as much as 30 to 40% gain in productivity. Let's say if the number of VMs managed by an FT in 2016 was 300, in 2024, that has increased to somewhere around 420 to 440 VMs. At the same time, if you look at an interesting trend here, automation curve is flattening for a lot of Gen 3 and Gen 4 outsourcers in the last few years. And this is where we feel generative AI would have a significant impact. With new disruptions constantly happening in this space, we feel, generative AI would become commoditized soon. The overall cost of implementing Gen AI would reduce. At the same time, you will see much more adoption from enterprises. And I think next few years are going to be very interesting. There's going to be a renaissance in productivity again. We expect to see a lot of impact of productivity in workplace, especially in workplace services, service desk, cyber security. These are the areas where we expect to see a lot of impact in productivity, which would actually translate into a good ROI even for the enterprises. You know, now, moving ahead, if we, yes, moving ahead, in the next page, if we look at,
Sorry.
yes, if we can move ahead to the, yes, now moving ahead, where exactly is the impact of Gen AI? felt. So what we are seeing currently is majority of the impact of Gen AI is at the lower end of the pyramid. And you see, most of the routine automation tasks, repetitive tasks such as monitoring, maintenance, basic troubleshooting, all these things are going away due to generative AI. And there is a significant reduction in L1 staff, especially L1 staff. And even what is happening is basically your L2, L3, and L4 layer, they are just there to take care of very complex tickets and issues. So that is where a significant impact is being felt, and we believe this is going to increase in the coming years, and we will see a lot of increase in the productivity, in the overall productivity. Uh, Now, I think going ahead, we've talked about generative AI, how it's really going to impact the industry overall, and now that we are coming to the end of the session, and if we go to the next slide, Ricky. Yeah. So I think overall, there are few key takeaways from this session. And what we'll talk about is uh, what we've done is we've observed there's a correlation. So from a pricing point of view, what have we observed? We've observed that there's a correlation between providers proposing more skin in the game, who are proposing more skin in the game in commercial models. They are the one who are actually winning deals. What clients appreciate is providers coming up with more innovative pricing models, solutions, and this is something we've seen increasingly. And we saw in the case example that Ricky covered before also. It's not just about being a lowest cost bidder. It's also about listening to the needs of the clients, proposing a solution that is tailored to the requirement of the uh, clients. So all these things are very important, when you're bidding for a deal. And the other thing I think we also talked about is, every industry has a very unique dynamics, and it's very important to really focus on that industry. What kind of solution you should be providing them, how competitive you should be there. So that is another thing that one must take care of. From a solution and delivery standpoint, what we are seeing is, uh, we are seeing a lot of vendors. They are leveraging tier two locations to drive cost optimization, and it is not just in India, it is a global phenomena. Even in nearshore locations, we are seeing an increased number of tier two locations that are being used. We are also seeing, I think it is clear, most of the service providers, they are making solutions based on, maturity of the client, which is very important. One solution fits all is not the approach that works nowadays. The other thing I think Richa talked about earlier, also poor customer experience. That is something that in our talks with enterprises, they have really reflected on this, that in the last few years, the experience level have really dropped for these enterprises. They are looking at vendors who are not just promising rosy story. They actually want providers to put their neck in the game, skin in the game, and really drive these transformations. Uh, Gen AI, I think we've talked a lot about Gen AI, and one of the most important thing is most of the clients that are looking are is there has to be clear articulation in what benefits are going to be provided to them through Gen AI, and uh, what would be the cost of implementation of these solutions, and what is the typical ROI that they are going to get through these tools. And that is very important, because what we've seen is there's a real Gen AI fatigue that is going with enterprises. There have been a lot of pilots in the last 6 to 12 months. A lot of failed pilots there. There is no clear visibility to enterprises on how to go about implementing Gen AI, and that is where service providers must come in, bring in more clarity. So that is really important in this phase.
Yeah.
See, now that we are at the end of the session, we want to open the floor,
Yeah.
to
Just
questions.
one
I
more,
think we've already seen. Yeah.
just one more point that I want to make before we wrap up this. I think an interesting bit is that if you fundamentally think about how an enterprise looks at spending on infrastructure and cloud and security, let's say if earlier it used to be, say, 50% of money is being spent on services or people cost and 50% is on technology, what we anticipate is 5 years down the line, that percentage may change, right? As more and more productivity-led enhancements will be driven through advanced tools. We anticipate that the amount of money that enterprises will tend to spend on technology will be a bit more higher than what they spend on people, right? And that we're already starting to see that. For example, productivity has gone up significantly since the last 6 7 years that we noticed, and Gen AI will probably bring in the next sort of wave of transformation, as Rohan was mentioning. So the amount of money that enterprises will spend on technology or tools or software will only go up, and more of that will replace the people cost that we currently have. So fundamentally, if you think about it, the margin profile of CIS deals is going to shift in the next 5 years, 5 to 10 years, because as I said, I think most of the current system integrators are very focused on people cost or services. And as that portion shrinks, it's important it'll be interesting to see how the industry adopts and how these sort of deals evolve. As Rohan said, let's open the floor for any questions. And we've already had sort of a lot of questions come in through the chat. I can take one of the first ones. So there's a question from Ryan Cummins in terms of what is the productivity percentage and associated savings percentage tied specifically to Gen AI? And do you see that upfront loaded productivity curve tied to specific Gen AI highlighted? I think, Ryan, there's no definitive answer to that. If you'd asked me this question 12 months ago, I would have said the typical productivity sort of called out in the out years of the contract. But over the last 6 months, or last 6 months or so, what we started to see is that there's a very strong focus on ROI, and clients would want to understand what use cases are you going to implement, what is my investment profile going to look like, and how much benefit is going to give me. As Rohan mentioned, that 2 to 2.5x is sort of the minimum threshold that enterprises need when they are actually trying to um, approve just approve a business case or any Gen AI investment. So I would say yes, most of these new contemporary deals that we're starting to see is sign now are already seeing some impact of Gen AI baked in, some of it in the initial years, but yes, more of it in the out years of the contract. When I say out years, typically year three, year four, year five, that's where we see more of that impact called out. Um, I think, Richa, probably you can take one of this question. Within the cybersecurity landscape, what's the trend of outsourcing some specialized services such as vulnerability assessments, pen testing, vulnerability management, especially with a lot of their enterprises having internal teams doing this? So, are you seeing more of this getting outsourced over the last few years?
So yeah, Ricky, for even for vulnerability assessment, vulnerability management, penetration testing, I think we see most of these enterprises also outsourcing these services. Specifically, for vulnerability assessment, we see a output-based pricing. So per IP typically is the metric that we see here. Pen testing is generally basis the number of tests that any provider will do for the end service provider. So yeah, those are typically on a per test basis and typically taken up as projects, depending upon how many
Mm.
applications to be pen tested, whether it's a mobile app, it's a cloud based app. So yeah, I mean outsourcing for these is still happening.
Okay. A few more questions, maybe. So, one of the questions is from how can we mitigate the risk in transaction-based pricing and user-based pricing? I think, Richa, maybe you want to take that.
Yeah, sure, Ricky. So basically, one of the primary risks associated with any transaction-based or user-based pricing is revenue volatility, which is driven by unpredictable workloads. And to mitigate this, providers can implement strategic measures such as a tiered or hybrid pricing model. Example, having a base fee plus a per transaction pricing, minimum transaction commitments, and also they can also offer volume-based discounts to encourage stable usage from enterprises. Additionally, introducing a 5 to 10% dead band also ensures that minor fluctuations do not immediately trigger cost adjustments, and it enhances predictability and also customer satisfaction.
Yeah.
Additionally, real-time monitoring and predictive analytics can also be brought in so that providers anticipate demand fluctuations and optimize resource allocation effectively.
Makes sense. Um, I think one of the hot topics that we get a lot of questions around is large deals, and the question is really around, can you talk about the differences in deal construction for large deals versus small deals and the bundling of managed services? So, Rohan, maybe do you want to talk about the criteria that we observe in the market specifically for large deals versus small deals, and how is their enterprises go about their vendor selection process?
Yeah, absolutely, Ricky. Now, I think the criteria often varies from organization to organization. And it's not just about the deal size, sometimes it's also about the maturity of the client. At the same time, for instance, a 25 million deal might have much stricter requirements than a $100 million deal. So that is perfectly possible. However, typically there are few basic guidelines for large deals. So larger deals, more often than not, will be having some kind of a transformation expectations. And here is where, most of the clients, they look at team quality, experience, credibility on, true transformation. These are the points that become super important. At the same time, some of the things that enterprises look is risk-free transition, uh, expertise in transitioning big accounts, providers need to have good references to justify this. Then the other thing, commercial flexibility, of course, for larger deals, large CVs, clients would want commercial flexibility of various kinds, ability to change pricing models, volume discounts. When you talk about bundling of managed services, you expect volume discounts there. Then co-investment, some type of investment on innovation funds. Uh, these become more important as the dollar quantum impact is huge for CFOs here. So some of the things also, I think what we've also seen is in some of the large accounts, providers are expected to feature in some of the large industry analyst reports, such as be it peak metrics, magic quadrants, etc.
All right. Maybe we have time for one more question, and this one is, let's say, um, what risk should customers be aware of as new pricing models emerge? Is Gen AI in procurement just another productivity tool? And maybe Richa, do you want to take that question?
Uh, sure. Ricky, I'll talk about the pricing model first. So basically, because the pricing models, a lot of modern ones are dynamic, it is making it challenging for customers to predict long-term cost. Variable pricing structures, example usage-based, metered billing, or consumption-based models can fluctuate unexpectedly, leading to budget overruns. Some pricing models lock customers into minimum commitments, making it costly to scale down when business needs and fluctuate unexpectedly. So, uh, to mitigate this risk, customers should demand transparent pricing breakdowns, conduct cost simulations before committing, and include periodic benchmark comparison clauses in contracts to align with industry standards, and negotiate flexible contract terms that allow for both growth as well as downsizing. And to your other question on Gen AI, whether it's just a procurement, whether it's just a productivity tool in procurement, well, no, it could be more than a productivity tool. Basically, it's a strategic asset that enhances vendor management, contract negotiation, risk assessment, and cost optimization. The procurement teams can use Gen AI to analyze historical spending. They can predict software licensing needs, optimize cloud service contracts by identifying hidden costs and inefficiencies. For example, Gen AI can automatically scan vendor SLAs to flag non-compliant terms or recommend alternative service providers based on cost performance benchmarks. It can also improve cybersecurity procurement by assessing vendor risk profiles, identifying gaps in vendor compliances like GDPR or SOC 2, and or they can also streamline RFP creation, supplier negotiations, spend analytics. So essentially, a lot of help to IT procurement teams to align their investments with business goals while
Yeah.
reducing cost and risk.
Thanks, Richa. Um, so I think I just want to reiterate, and there are a lot of questions, and sorry we've not been able to answer a lot of them, but what we can do is definitely try and tackle most of these offline. You'll probably hear from us in the next couple of weeks as we sort of try and create responses to these and share with them with you offline, because there are more than 40 odd questions which are open currently. So we're not be able to answer all of those immediately as part of this session. While we wrap up, also wanted to reiterate we have offered a complimentary price check, as Rohan mentioned. The link should be in the chat. So if you want to make use of that, sort of just get some complimentary pricing data, compare it to in terms of how it compares to your internal sort of benchmarks, that might be useful. The other bit, and this is on the slide over here, we are hosting our first major conference in Europe, in London. This one was we had a sort of a sister conference in Dallas, which was a very successful in October last year. This one's our first major one in Europe, and we're bringing it to London. So if you're interested to learn more, please visit our website. You'll get a lot of details around it. Maybe given that we have a couple of minutes, Rohan, maybe I'll ask you to take this. I think you've done a lot of work around this, and this question pertains to what negotiation strategies can be used for cloud contract negotiation with hyperscalers like Google and Microsoft. What's your take on this?
Interesting question, Ricky. To be honest, hyperscalers are one of the most toughest industry clients to negotiate with. And but we have seen enterprises, they can look to negotiate with hyperscalers. And some of the areas like payment terms, we've seen situations where customers have negotiated better payment terms, say 45 to 90 days as against the hyperscaler standard of 30 days payment. What we've also seen is we've seen a lot of customers negotiating price protection clause in their long-term contracts. Hyperscalers would not be increasing their rates of contracted services during that contract time. Typically, long-term agreements, customers are able to negotiate these things. Then I think one of the things we've seen in some cases, audit rights being negotiated where, hyperscalers have agreed for a fixed frequency, sorry, customers have agreed at a fixed frequency where audits will be conducted against the standard audit clause. I think these are some areas we have seen hyperscalers negotiating.
Yeah, makes sense. And I think I agree. I've seen they're very fairly difficult to negotiate with given the size of this and the scale at which they operate in. But yeah, some of the pointers around price protection, payment terms, yeah, these are sort of some of the low-hanging fruits you can put, which most enterprises should potentially look at as they sort of look at negotiating their cloud contracts in the coming years. So we are at the top of the hour, so we'll not be able to have more questions on this. But as I said, please be wait, sort of park those questions. We'll definitely get back to you offline, and do feel free to make use of the complimentary price check offer. With that, we want to wrap up, and thank you so much for joining us today on your evenings and making sort of keeping the session very interactive. We look forward to hosting you again. Thank you.